In my video from last week, I made this prediction. This blue line, heading higher, shooting higher. The equity markets are going up, and the risk confidence is moving higher fairly quickly here. Just from this chart alone, I'm going to predict that we're going higher next week. So how did that turn out? Well, as you can see, I was right on Monday, wrong on Tuesday, right again on Wednesday, and then right again on Thursday. But by Friday, none of the indices and ETFs closed higher. So kind of a mixed bag for this last prediction. What does Cathie Wood know about the economy that no one's talking about? Let's take a look at how the equity, bond, gold, and crypto markets are looking right now, and what gold and Bitcoin are likely telling us about the potential risks in the economy. Well, if we look back over the past week, you can see that the markets kind of meandered, started out nicely on Monday and then kind of fell apart on Tuesday, rallied Wednesday and Thursday, as I mentioned earlier, and then kind of pulled back on Friday. So overall, kind of a flat to down week. Not a great look. And if we look back over the past month, well, it looks like somewhat of a healthy rally here. You have small caps in first place, ARKK Innovation in second, S&P third, NASDAQ fourth, and Dow just lagging slightly behind the NASDAQ. And if we look back year to date, you can see that we've had a very nice risk appetite with the NASDAQ on top, but the small caps and ARKK Innovation, the riskiest baskets of stocks, are really kind of lagging here. In fact, ARKK is behind the Dow, and small caps are behind the S&P 500. So not a stellar look by any means. And if we look back over the past year, these returns are phenomenal, but ARKK still has not surpassed its previous peak here, and it's still below the NASDAQ. I would expect if things were really good, we would see ARKK Innovation move above the NASDAQ and stay there. We're not there. And what are the bottom dynamics telling us for this week? Well, it's kind of a mixed bag here. I don't even know if I want to make a prediction, because you see the price of the S&P and the other indices all pulled back on Friday. But what's interesting is the bottom confirmation is actually rising here, but yet we have falling risk confidence. I mean, if I were just going to look at the bottom confirmation, rising and falling confidence, I'd say we're going lower next week. Now, that's an easy call since we kind of ended up this last week lower, but I'm not basing it off of that. Just basing it off of these two. I'm hesitant to make that prediction, though, because the price was also falling, which is kind of a divergence with what's going on with these two. So really don't know how to call this. And if we look at risk versus opportunity, these metrics underscore the idea that the markets could go lower next week. I really don't like the fact that risk acceleration, this yellow line, is above 60. And you can see it dipped here a little bit below and it's back above 60 again. This is not a good look at all. And you can see that risk is really starting to shoot higher. Again, not a good look at all. This is a lagging indicator, but this is pretty timely. And you can see that the opportunity level is falling off as the market dropped on Friday. Not good looking. Now I'm going to show you something really scary. So if we take a look at equity versus safety, let's just jump into the overlays because this really tells a story. So if we look at equity versus safety, you're going to notice a flight to safety here. Now, you're not going to see it here with this overlay. It's not as obvious, but what you are looking at is small caps falling back, NASDAQ 100 really falling back. What's interesting, though, is that cash is falling back. That's usually a good thing, right? Well, let's take a look at what's happening. All the equities are falling back. Small caps, S&P 500, NASDAQ 100, and the Dow. All of the equity indices lost ground here in this past week. Well, let's overlay some safe haven assets to see what's going on. So I said that cash falling is usually a good thing, but not when gold goes from 7th to 1st place and long duration treasuries go from 10th place to 3rd place. This is a total flight to safety. Not a good look. And if we look at safe haven assets, and I left gold in here just for reference, you can see what's happening. The longest duration treasuries, TLT and EDV, both went from 9th and 10th place up to 5th and 3rd place. And then cash fell, intermediate treasuries fell, and short duration treasuries fell. So in general, this is a healthy looking risk appetite for long duration treasuries, I think caused by a flight to safety. So what do the buying and selling pressures tell us about what's happening in the equity markets? Well, if you look at the Dow, you can see the price has been declining. You can see that since back here, the selling pressure, this solid orange line, has a slight incline to it, so it's rising, while the buying pressure, this solid gray line, has been somewhat on a decline. So not really good looking. And if we look at the S&P 500, that's been performing a little better. And you can see that the selling pressure hasn't been on as much of an incline. In fact, it's been declining since back here, but then it bottomed here and is kind of on the rise and is pointing higher. So this is not looking great. If we look at the NASDAQ 100, you can see that the price has started faltering recently, and the selling pressure, this solid orange line, is starting to shoot higher. Now, it needs to get up a lot higher than this for me to be truly concerned, but it's going in the wrong direction. And if we look at ARK Invest, interestingly enough, it was one of the few things that went up on Friday. And you can see that the buying pressure is increasing here. So that's kind of a mixed signal when you look at these three things. And how does that compare to small caps? Well, if we look at small caps, they look just like everything else, except the price is actually kind of moving up very nicely here, except for on Friday. And the buying pressure was very nicely above the selling pressure, but you can see the selling pressure shooting higher. And what if we look at sector rankings? Well, I'm going to kind of skip over these because, as we've talked about week after week, these are very, very late to the game. They're very slow to respond. Now, they are finally showing that we have had an unhealthy Treasury market, but as I just showed you in equity versus safety, the Treasury market is starting to look very healthy, so that's not showing up here. Let's go to sector rank acceleration. And even here, you can see last week, Treasuries were in an unhealthy relationship, and they were. Cash was about in the middle. Gold was here. Consumer staples were way up here. And if we go to this week, you can see consumer staples have really fallen back. And why? I'm not surprised. Look at what the Dow has done. The Dow tends to not be consumer staples, but they are safer, large companies. And you can see that the Dow went from here all the way down to here. So not surprised to see consumer staples dropping. Consumer discretionary really pulled back. And you can see that 20-year treasuries slipped down here, and they're still showing an unhealthy relationship here. So even this hasn't caught up to what we're seeing in equity versus safety. And how do treasuries look? Well, if you look back over the past week, you can see we've got a very healthy risk appetite for long duration treasuries. And this is the flight to safety. EDV right up here at the top, TLT in second place, and so on, all the way down to the shortest duration treasuries. This is a very healthy appetite for risk, or a very healthy fear of equities. We'll have to figure out which one it is as we go forward. And if we look back over the past month, you can see what's happened since back here in late February. The longest duration treasuries have really taken off and headed higher. What about year to date? Well, year to date, you can see that we had a sort of a double dip here, and now they're starting to move higher, but still have a ways to go before this becomes what I would call, I don't want to use the word uninverted. You really want TLT and EDV to be above these shorter duration treasuries, but you can see they're moving up much more quickly here than these are. So if this keeps up, they will be ahead of these year to date. And if we look back over the past year, you can see that we had a real absolute collapse here of long duration treasuries back in November, October, November of 2023. Then a huge rally and then a pullback when the Fed indicated they might not lower rates as quickly as everybody thought. And now we're in rally mode again. So look, even for EDV to get back to zero, not even above the line, just back to zero, it's down 10% here. So it's got to go up, let's call it 12%. I'm probably in the ballpark, just to get back to zero. And that's a very healthy gain for a fairly safe government treasury investment. What about buying and selling pressure for treasuries? Well, if we take a look at this, you can see the flight to safety. Short duration treasuries, price shooting higher, selling pressure collapsing, and the buying pressure, the solid gray line, well above the selling pressure. What about intermediate treasuries? Again, price shooting higher, buying pressure through the roof, up here way above the selling pressure. Intermediate to long treasuries, 7 to 10 years, again, price shooting higher, buying pressure going nicely higher here. And then if we look at long duration treasuries, 20 years, they actually pulled back on Friday, unlike all the others. And the buying pressure is still well above the selling pressure, but they weren't as popular as the 7 to 10 years and intermediates and short duration. This kind of indicates to me that investors in government treasuries are still afraid the Fed isn't going to lower rates quickly enough. And what about that inverted yield curve? Well, you can see the blue line, the solid dark blue line, that's where we are today. The red line is where we were a month ago. They're almost neck and neck here. And then the light blue line is where we were a year ago. At the short end, yields are about where they were a year ago, but you can see that rates at the long end have gone up much more than they were a year ago. So a year ago, we were much more inverted than we are now. Currently, we're about 40 basis points inverted. This would have been much higher than that, much worse. So that is somewhat of an improvement, although this is worse than it was last week. So how's the Fed rate monitoring tool looking? Well, with 1 week and 3 days to go before the Fed meets again, it looks like the markets believe there's a 96% chance that the Fed will leave rates unchanged right where they are. What if we go out to May? How's that looking? Well, May, it looks like 75, almost 76% chance that rates will be right where they are. And if we go out to June, well, now you can see that there's more of a likelihood that rates will be lowered by 0.25%. Go out to July. Now you can see that it's more likely that rates will be lowered 0.25 to 0.5%. And then so on. As we go out further in time, you can see that that little blue line gets smaller and smaller and smaller. And finally, hopefully when we get to December, oh my God, it's still there, 0.1%. But I'm assuming by the time we get to December, especially if you listen to that Cathie Wood video that I referenced in the beginning of this video, you'll see that the Fed's probably going to get caught by surprise, and we could actually end up in a deflationary period very soon. And what about gold? Well, gold seems to be the star. Look at this thing. My God, the price is just shooting higher here. It's going parabolic, as they say. And you can see the buying pressure bottomed out here, back here, and has been just on a tear since then. So this is indicating fear of something. I'm not quite sure what, but it's a fear of something. This is looking really good for gold, at least for the near term. And what about Bitcoin? Well, you can see that the price action of Bitcoin has been very, very nice. A little bit of a pullback here, and now it's heading higher again. And the buying pressure, while it did collapse here, is kind of intertwined with the selling pressure. So no real clear indication here. It'll be interesting to see how this goes next week. Look, with both gold and Bitcoin shooting higher recently, what does that tell us about the potential risks to the current economy? Well, here's what Cathie Wood had to say in her In the Know video, published just a few hours ago. Link in the pinned comments below.
You can see that gold is breaking out here. Is this a flight to safety? Are there things going on out there, whether it's commercial real estate in the US or recessions around the world, or crackdowns in China and Russia and elsewhere? Is there a flight to safety? We don't know why the gold price is going up like this, but it is interesting to note that the metals to gold price is still near a very low level, near recessionary levels. So that's kind of interesting. Here's the Bitcoin price, out to a new high. It did touch intraday on a couple of days that 70,000. And, we wonder how much of this is because of the ETF launches and all of the publicity and the competition among the 11 ETF issuers, and how much of this is flight to safety. After all, we heard New York Community Bank under duress has now been taken over, and there's another bank in Philadelphia. So there's no counterparty risk when it comes to Bitcoin. And so maybe that's part of why Bitcoin has shot up here. And as you know from our research, we think this journey has miles to go.
Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water. Wet my lips, but the sun's stronger. Pour it out, if I'm being honest. It's just not everything you promised. Running out, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold-proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold, but it's lonely, yeah. This life feels like the sunny water.